Hello, and welcome to the Bankers Tech Talk video series, looking at all things fintech. We've been going now for about 6 years, and you can watch all the previous episodes on thebanker.com/techtalks. I'm Joy Macknight, editor of The Banker, and with me this week is Tanmai Sharma, who is CEO of Canopy, which is a data aggregation and visualization platform. Thanks so much for joining me, Tanmai.
It's a pleasure. Thank you for having me.
So how does a wealth tech platform like Canopy really address some of the challenges that the banks are facing today?
Data is the new oil. And a lot of the challenges, a lot of the costs, a lot of the expenses are around data in various formats. In a normal private bank, this problem is complicated because the product itself is complex. They have many products, and these products evolve usually much faster than your systems do. So there is always some gap there, and you have some workarounds that you're using to book certain transactions. And a typical private bank or typical bank will have an operating system, and then they will have plugged on modules, which will be the equity trading system, the bond trading system, etc., which will be usually made by different manufacturers, and there's a lot of sellotape and araldite, which is kind of putting them together. So uh, data is a mess more often than not. And I find, for example, a lot of banks are not able to do something as straightforward as telling the client what all dividends were received on a particular position. Very often the client wants to know that because they want to know what coupons I got on this bond, for example. And more often than not, you have to file a tax statement. So that for that, you need that information. So the bank will then sometimes give you a consolidated statement at the end of the year, and it's all sorts of funny things happen. So what we are doing for the bank is we say, don't change anything. It has costs, it has other implications. We will take your data in its existing format. We will clean it, we will standardize it, we'll do everything, and then we will present to your client and your relationship manager and your investment counselor a consistent data layer which is correct, and it has all the information that you could conceivably need, and it allows you to combine components and bring them together. The other thing that we're doing, which is very interesting, is because clients don't want to put all their money in one bank. So they typically have about a 20% cap on how much money they put with one bank. Banks are now starting to advise on held away assets. This is actually a reasonably big thing in North America for quite some time, but it's now becoming big in Europe and Asia as well. And like I said, 5 or 6 banks are now having this conversation with us where they want us to help them on advising on held away assets because even though there is a cap on how many assets the client will keep with you, it doesn't prevent you from increasing your fee pool.
So in mid-2020, you participated in the Monetary Authority of
Mm-hmm.
Singapore's
Mm-hmm.
industry pilot project.
Industry pilot, yeah, it's still going on actually.
Is it? So
Mhm.
what have you learned from the experience?
Basically, data is a mess, and a lot of people spend a lot of money, a lot of time, and a lot of effort in getting data right. And 80-90% of my conversation with my clients and my prospective clients is all around data and data cleanliness. So that is the problem. And what we are trying to do, as a result of this is. Trying to arrive at some sort of, even if it's not a standardization, help the banks and help the clients make this process easier. And the end goal is to make it efficient and cheaper for everybody, something that hopefully helps the system at large.
In terms of private banking, what do you
Mhm.
think it will look like in future?
What we are finding is the customer is getting smarter and smarter and smarter, and the customer is getting digitally savvier and savvier, and the customer is a shopper. So the customer is constantly shopping, looking for value and looking for whatever, but at the same time the customer is willing to pay for value. So so it's becoming a very very nice marketplace, as I said. So, to the extent you are a bank, you have a product, the customer is willing to pay for it. And I don't know if you saw, but EY does this survey every 2 years, and they just came out with one recently. And their survey says that clients are even willing to share their held away assets with their bank if they get service in exchange. So essentially, paying not just with cash, but paying also with data. So data being the new oil and all that. So effectively, what I suspect will happen is that people will still diversify custodians because they don't want to put all their money in one place. But who they buy their services from will become more merit driven, or the better product wins kind of a thing. So I suspect that if you're talking 10, 15 years down the future, the you only trade with your custodian will not be the done thing. Your custodian is a separate thing, and your who you trade with or who you get advice from is a separate thing. And and it's a very value driven, who provides me the best value kind of a decision. I suspect that will happen. In fact, if you go away from the private bank and you go to the institutional market, this is how the institutional market behaves and has been doing this for years, for 20, 30, 40, 50 years. So I suspect that model will, where you split custody from everything else, will come in. You will still custody with multiple banks, but you will divide your business disproportionately towards the people who provide best value.
Well, thank you so much for your
Oh,
insight, Tanmai.
pleasure. Thank you so much.